Oh, yeah. You thought I was going to forget about it, but I wasn't, right? Fresh off the basketball court, sweaty as heck. But we're still making a video for you tonight. It's what we do, okay? Been tracking this one, obviously, as it released. Netflix just reported some earnings after hours today. We're going to release this late night, baby. So hopefully we get people watching it. You better tune in, whether you do it tonight or tomorrow. Let's see how loyal you are. Let's see. But overall reaction of the stock was at the start very, very negative. We saw a big dip, down around 3.5%. From there, it leveled out very, very steady to end slightly up. But overall, initial reaction was very negative, and then people kind of rationalized it a little bit. They salvaged a little bit with the conference call, but let's take a look at some of the notes here and what I'm really looking at. You look over the last year again, you need to mention the stock hasn't necessarily had the best fortune in the last year when a lot of stocks have taken off in this time period. Netflix here is only up 8%. Now, different story when you look in the past 5 years, up 500% is quite incredible. We're talking 100% annualized growth rate there is quite incredible. You can't really expect to have 4% annualized growth rate forever, but hey, it's okay. That's even with this year. But let's look at these earnings. If you don't recall, I did make a earnings video. What I'm looking for. Didn't expect much out of these earnings. Obviously, we see them right here, but I really am not looking super positive with Netflix in terms of subscriber numbers, specifically because I mentioned that content is king in this game, and there's so many competitors now. If they want to continue to add users, which is how this stock goes up, the stock doesn't go up based off of revenue nor EPS line. It doesn't. It goes up from memberships right now. That's kind of just how the game works with these stocks. And I wasn't expecting much because this is not a company releasing a lot of new content lately. They just really aren't. They're relying heavily and really successful right now off of the old content, but that old content doesn't keep people coming onto the platform, right? It'll get people leaving it and coming in at the same rate maybe, but you can't gain new users and keep them easily without producing new content for them. Not everyone wants to join on just to see their top five shows are pretty consistently old sitcoms from the 80s and 90s and 2000s. But that's not something that's going to be a steady trend to bring new users on, unfortunately. But we'll see here a GAAP EPS of $2.97, misses by 19 cents. Profitability miss. I don't know. I didn't know what to think about for the EPS line. I didn't think they would miss, frankly. But a little disappointing in that aspect. I'm curious what that expense took place would be. Again, my mention was the only way they would probably miss their pretty decent estimate there was going to be if they spent more on content. So maybe under the wraps they're spending more on content we don't know about. Revenue line here, $7.34 billion, is up 20% year over year, which is pretty darn nice, and a beat by $20 million. Not super crazy. We look at the global streaming paid memberships of 209 million, which overall kind of disappointing. If you look from the headline, they only added 3.5 million new members this quarter, which is pretty disappointing for this company, right? Their estimates were a lot higher than that, and you look at the guidance and it's pretty disappointing. They're expecting much less than you might really anticipate. They're expecting adding 3.5 million more. The consensus was to add a solid 5.5 million more, and they're 2 million short of that in their estimates. So hope maybe they're just softballing. Who knows? But yeah, net additions, they were expected to add 5.9, nearly 6 million subscribers, and they are only going to plan on adding 3.5. Kind of disappointing. Revenue line pretty well meets consensus for the guidance, and the EPS line shows higher than what the consensus is, so we'll see what that looks like. And again, this first thing kind of sums it up there. It's hard to live up to Wall Street expectations right now because you're going to be a top of the end subscription company right now. You have to be showing that you can keep a consistently incredibly high growth rate, which I understand personally is not necessarily feasible for companies who reach a certain level. There's really a limit to what you can do. You're not going to be able to infinitely increase that, right? Law of large numbers. Investors don't get that. Hedge funds don't get that. They don't really understand that. They really didn't take a lot of math classes, I assume, through their curriculum in high school and college. I really don't think they did. But I understand it, but still, it's the market we live in right now. If Netflix wants to stay a top dog and a top performing stock, you got to keep up with their expectations, which is incredible subscriber growth and revenue growth. So I believe it'll add 3.5 million new subscribers in the third quarter, which is, as we saw, short, less than expected. It added, this is what's disappointing. This quarter, they added 1.5 million subscribers, which is very, very low for them. But again, they gave a very low guidance themselves, but their estimate, the estimate for them was only 1.12 paid new memberships, which is disappointing. And when you see a number that low, it's obviously, again, it's like I mentioned, it's hard to bring people on without content for them. You know what I mean? It's really hard. Netflix has more than 209 million subscribers worldwide, as we saw. The company is said to still be dealing with some lumpiness, which is an interesting word of saying it, due to the effect of the pandemic, which doesn't make any sense. I think this is a very ridiculous excuse by them. The only the only effect that they had due to anything related to that was a very, very positive one. Very positive. It was the best thing for these companies that could have happened. It is. The people had more time, and they still do, especially with a lot of remote work still happening. People have a lot more time to view content, and that's benefiting them quite a bit. There's no reason why their membership isn't growing because of it. Just being honest with you. That's just I think that's a BS answer. And I hope people see through it, but I don't think people really did. During the second quarter last year, they added 10 million new subscribers again. That's what I'm saying. It is a benefit for them. It's not a, they're saying that it distorts the comparisons, but again, you still should be adding more. I don't know. I think it's just a little bit of a garbage excuse, but, that's okay. Yeah. What else we see? So, Netflix results hinted a possible rough road ahead. This is what I think is quite crazy. Combined, the company lost 430,000 subscribers in the U.S. and Canada during the second quarter and added 190 paid in Europe, the Middle East, and Africa. That is the number that concerns me again, because you've seen U.S. has been a very weak segment for them. They'll blame pandemic, won't they? Which is BS, but this is where we see the issue, right? The people that have had the Netflix service for so long realize there's nothing to watch on there besides old shows. The new content isn't coming out. They're leaving the platform. That's what's going to happen. Now, they can easily capture them back when you get something like the new Stranger Things season, which has been in production for about 15 years now. But this is what they have to do, right? This is my concern here. The losing of subscribers in the U.S., it is disturbing because this is not a once-in-a-lifetime thing for them. It's been kind of a trend for them, unfortunately. So, and they'll say, Wedbush analyst here says that the market saturation, the market's saturated is what they're saying. So competition has to be fierce, which means more series. But let's look at the shareholder letter, see a little bit more for us if we can. You've seen revenue's been in a pretty good shape here, pretty consistently, and expected some more growth here. When you look over the quarters, I like to see that. Operating income, pretty nice. This quarter was pretty darn good for them, and you like to see that. From a net income standpoint, really, really good quarter. Last quarter, this quarter, not quite as satisfactory, but still better than last year by a good margin. And you see where the subscriber growth really starts to slow down here. 27% last year's quarter, then 23, 22, 13, 8, and 9% expected coming up, which is small net adds, but kind of disappointing. I don't know. That's my opinion of the matter, but who am I to say anything? So what else can we see? Weekly paid, global paid net adds year to date. Again, this is one thing that I think people should find a little concerning. They're going to say it's off skew because if you combine the 2020 and 2021, it'll level out to where they were the years prior. It's just not where it needs to be, in my opinion. I think if you're doing it right, you capitalize off of 2020 and you continue to add more in this year. That's what companies like. That's what other companies are doing. Disney Plus had no issue doing it. They really didn't. So why are you going to complain that you're having an issue doing it? So full year is going to end up way, way short of what they've been doing in the previous 4 years. There's no doubt about it for me. So don't like that. But good to see a growth in operating margin for sure, because the company needs to make some dang revenue, dangle revenue for sure. I would want to scroll down here and look at, they give obviously environmental factors, what could be affecting it. I don't care. I'll look at the balance sheet as I always do with these companies to see what's going on. I expect should be good things out of that due to a pretty good net income line for them and good growth year over year. But let's take a look. $9.6 billion here in current assets. They give me a 6 months comparison. Comparison $9.7 billion, so not much of a change. Small decrease in the cash position. Total assets in general at $41 billion compared to $39.2, so there is a growth there for sure of around $1.8 billion, which I like to see. I do like seeing it. From a liability standpoint, pretty consistent here, 7.8 to 7.8. Slight increase, nothing crazy. And liabilities actually saw a decline here, 27.1 compared to 28.2. So stockholder equity, it's looking in good shape here, 13.8 billion compared to 11 billion. Could look better for sure. Balance sheet could look better, but overall, pretty decent numbers there. I think the balance sheet's got a decent bit of, I like the amount of cash on it. I like the balance sheet in this company. I think it's heading in the right direction. So I really do. Yeah, I like it. But that's what we got for this stock. Again, I don't think this stock's necessarily a buy at this rate. I really don't. I think because of the slowing subscriber growth, this stock will continue to trade stagnant this year because Wall Street has very, very high expectations. I really think this thing will trade level because Wall Street wants incredible subscriber growth that the other companies are presenting, even though they're not established as much as Netflix, and they're not going to be able to do it. They just won't be able to keep up, unfortunately. So that's what I got for you, and I hope you have a good one.